Welcome back. Today we're going over a super interesting small cap stock that could be a multi-bagger in the next few years. The name of the company is OneWater Marine Incorporated. I have their investor relations page open right here. And then you can see in the top right part of the screen, I have the stock price, which is a little over $29 a share, and the market cap that's about $460 million right now. So who is OneWater? They are actually a boat dealership company, and they're also a serial acquisitioner, which means that they grow by buying a lot of other companies, and all the companies they buy are also boat dealerships. So they're just like this boat dealership conglomerate. And what immediately jumped out to me was something that Monish Pabride said about the auto industry. And he's talked about this before in a lot of interviews where he talks about, okay, look, auto manufacturers are a terrible business, mainly because you have such high capex and you're always having to reinvest money in the business just to tread water. Whereas dealerships, and this is auto industry he was talking about, are great because they have very low asset requirements and they actually make a lot of their money from the parts and services part of the business and from the financing part of the business as well. And to me, this translates even better to boats, right? Because like the quote up top says, right? Everybody says if you own a boat, it's like having a hole in the water that you throw money into. So I was like, man, what if you own the other side of the hole where all the money's going, right? Because that money that they're talking about are the parts and services that's associated with owning a boat, right? Real quick, what I'm going to do is I'm going to go to their investor presentation just to give you a quick overview about the company. And then from there, I'll dive into the financials. We'll talk about what we think the stock's worth. And one big disclaimer before I start the video is that I do own some shares. Now, it's a pretty small position for me, and really the purpose of this video is for me to try to process whether or not I want to double my position, triple my position, or maybe even exit it, because the price has moved around a ton because they just had their recent earnings announcement, I think last week, and I think it dropped like 10% since then. So could be a buying chance. Or did something come out in the earnings that makes it kind of, iffy? All right, so let's get started. Here's their investor presentation that was from November 2022. Here's their disclaimer about forward-looking statements. That's at a glance. I'm going to go to kind of where they are, all their locations. Okay, so you can see they got a lot around Florida and then some other states and a little bit on the West Coast and then some on the East Coast. All right, moving to their income streams. All right, this is super interesting. You can see their boat sales are about, 82% of revenue between the new and the pre-owned boat sales. I love the word pre-owned. It's just like, just say used, right? Pre-owned boat sales. And then, and I'm not knocking them about this. Every car dealership does it too. And then finance and insurance, and then parts and accessories is the remainder, all right? So 18% is finance and insurance and parts and accessories, but you can see that's, even though it's only 18% of the revenue, it's 30% of the gross profit, all right? So it's really bringing home a lot of the profit, and that's something that Monish Pabride talked about with auto dealerships as well, right? That a lot of the profit comes from this side of things. And this, if you follow the company at all, you'll know that this section here, the parts and accessories, has really been growing, which is great because that is the best part of a dealership business. All right, and then a little bit about how they grow. This is their acquisition strategy. So basically, they aim to pay about 4 times EBITDA for the dealerships, and then 5 to 10 times EBITDA for the parts and accessories businesses. And then their goal is actually to double that EBITDA in 24 months, or 2 years. It's not a baby. We can name it in years, right? Okay, so anyway, I know what you're thinking. EBITDA, that's terrible, right? I hate EBITDA. Now, I will say though, EBITDA, whenever you're buying a business outright, especially buying, the whole enterprise value, isn't necessarily the worst thing, right? Because, for example, the 2 things I hate about EBITDA are interest and the I and the D, the interest and the depreciation. So the interest I hate because it just ignores whatever debt you have. And if you think about it, if you're buying out a business completely and you're buying the equity and the debt, the whole, invested capital, then you don't really care what interest they're paying now, because once you buy it, it's going to be gone, right? You're going to buy out that debt. That's if you're buying out that debt and the equity, right? And then depreciation, if it's a boat dealership, it's not really an asset heavy business. So depreciation isn't as big of a deal to me as like a manufacturing business, right? Okay, so that is just the highlights of the acquisition strategy. Now I want to show you something crazy, which is their growth over the last, 6 years? 5 years? 5 years. All right, so from 2017 to 2022, they went from $391 million of revenue to $1.7 billion. Okay, that's a compounded annual growth rate of 35%. Crazy growth, all right? And you think that's a lot. Look what their adjusted EBITDA did. Went from $18 million to $248 million. 69% growth rate. Now, if you know my videos, you know that this number actually means nothing to me, right? So what we're going to do is actually look at the financials, see the health of the company, and see if we can get a good value. All right, so let's get started with the income statement. So I already touched on it a little bit, but this is total revenue, and this is just every quarterly report going back to June 2018, and then I put it on this graph so that you can see it, right? And what I want to do next is actually look at net incomes. Let me find net income. All right, and I did put some asterisks there because that's the net income attributed to the common shareholder, because they actually have some preferred shares that take some income before it gets down to the common shareholders, okay? So that's why I put the asterisks there, okay? Anyway, it's definitely not as good as the EBITDA number, right? I mean, that the EBITDA for the last year was $250 million, and the last 4 quarters have been about 120. So not terrible, but it's still, it's not that EBITDA number that they're talking about. What's interesting if you look at this EBITDA is that like the trough earnings, this $10 million a quarter, which is the most recent number that spooked everybody and caused the stock to drop, is actually, on a quarterly basis, if you were to take that for a year, it would be $40 million. And, just dividing the market cap by $40 million, it's selling at 11 times those trough earnings, okay? Now, what they said, and I'm not going to pull it up, you're going to have to take my word for it, is that the earnings in this most recent period usually account for about 15% of the yearly. So what I would do is divide that 10 divided by 0.15 to find what the total is. And you can see that, like, according to that, we're thinking more along the lines of 670 million, okay? So now you're talking about selling at a future PE of maybe, let's see, 458 divided by 67 of about 7. So single digit PE with that crazy growth, okay? Really good. Okay, but before we move on there, I want to show you something that is a little bit concerning, and that is their interest payments. So what I did is I took interest and then I divided it by operating income. And you can see the most recent quarter is actually 47% of their operating income went to interest payments. Okay, so what the hell is going on there, right? We went from single digits to 17 one quarter before, and now we're at 47. That's wild, okay? So what I'm going to do is I'm going to pull up their 10Q to kind of talk about that a little bit. Okay, so here's their 10Q, and I'm going to go down to the income statement, scrolling. Okay, so other expense, interest expense, floor plan, and then interest expense other. All right, look at this look at this jump both of these had in the most recent quarter. This isn't sequential. This is year over year. But anyway, floor plan interest. Okay, so floor plan debt is debt that dealerships use to buy their on the floor inventory. Okay, so it's not really I don't want to say it's not like real debt, but if they fail to make a payment or something, or make the interest payment, I think that the inventory on the floor is kind of the collateral there. So it's not like the company's going to go out of business. That might be wrong, but that's just kind of how I interpret it. And then this other interest expense kind of goes to what I would think of as like real debt. Okay, so still a lot of debt. I mean, it's still about 2/3 this real debt and 1/3 the inventory debt. But yeah, that's just weird. That's pretty concerning. I'd like to know more about that and probably drill down into like what exactly is that debt made up of, when is it due, that sort of thing. Okay, not for this video though. All right, let's go to the balance sheet. All right, so now onto the balance sheet, and you're going to see why people say dealerships are such good businesses, right? And that's this number right here, the pre-tax return on tangible assets, okay? So what Warren Buffett says is that a good business is one that earns a good return on assets or good return on invested capital. A great business is one that earns a good return on growing capital or growing assets, okay? So first off, you can see it's growing, right? But now we're going to look at the return on tangible assets. And we're looking at tangible assets just because as an acquisitioner, is that even a word? I don't know. But as somebody who acquires other companies, how about that? They're going to have a lot of goodwill. So I'm going to look at tangible assets to see what kind of return they're getting on their total asset base. And look at this, over 25%, even in that trough period. Okay, so really strong. If they continue to make 25% on assets, I mean, that's outstanding, right? So that's a huge check mark, okay? All right, let's move to, let's see. I'm going to go to debt to equity ratio because, like, I looked at the debt as a function of, like, I guess compared to their income, but now I want to look at it compared to their total equity, right? And I like this as low as possible, like, less than 1. But, if you look up the business school definition, I think it says less than 2.5, but they're right around that 2.5 number. So a little too leveraged compared to what I normally like, but, not crazy. But anyway, that must mean they have a crazy high interest rate though. But anyway, okay, let's go to lastly, ordinary shares numbers. So this is, are they diluting shares or are they buying shares back? Now, it just IPO'd, I think, in 2018, so I'd be surprised if they were buying shares back already. But yeah, this is not good, though. I mean, I really don't like seeing this. I guess in these cases, it was probably they had an offering to buy another business, right? And here, this small growth, it's probably they're not diluting or they're not having secondary offerings or anything, but that's probably just how much the shares are growing by the employee compensation. So not great. What also bothers me about this, if I go back to their presentation real quick, remember this EBITDA number? They're $248 million for EBITDA right now, which means that the market cap is 458 divided by 248. So right now they're at 1.8 times EBITDA. Their goal, and they said, is to buy other businesses for 4x EBITDA and then get it to 2x. Well, they got the chance now to buy their own business, buy a bigger share in their own business at 2x already without doing any work. Okay, so that just seems like a no-brainer to me. But if I was a shareholder, which I am, but if I was a super large shareholder, I'd be really pushing for that, right? Okay, but that's enough of the balance sheet. Let's go to the cash flow statement. All right, so for the cash flow statement, we're going to start with operating cash flow first, okay? And this is all your cash from operations. So to me, this is a great check against income to make sure, things are checking out. And this is spooky, all right? The most recent quarter, this is probably what spooked everybody. Minus $140 million of cash flow. Now, my guess, and I say I guess, I already know the answer, right? A lot of it is going to be change in inventory, okay? Because they're actually building inventory. And you can see, yeah, that's it. $150 million is that change in inventory. And what that means, if you ever see negative on change in inventory, it means that cash is leaving the business and inventory is coming in, okay? Which is really, can be a sign of two things, right? It can be that the company's building inventory for potential future sales, or it can be that there's no demand right now and that we're in trouble moving forward. The good news is that this is historically the time whenever they build inventory, as far as the seasonality of the boat industry goes. But it's really scary because, like, if it drops again next quarter, I think that would really throw some people for a loop, okay? But anyway, another thing that goes into this is the stock-based compensation. And this is going to be a positive adjustment to cash flow because what happens is, like, for income purposes, they have to account for all the stock-based compensation they paid people, but it's not real cash, It's not cash leaving the business. It's just us, the shareholders, getting diluted, so they don't have to count it. So they put it back into the cash flow statement. I like to count it, but that's just me because I'm a shareholder, right? And this is, like I said, this is a little bit frustrating. I mean, you have $2 million a quarter going to stock-based compensation, and you have, negative cash flow. It's strange. This is weird puzzle, okay? Then I'm going to go to CapEx, and this is kind of another example of that good business, right? Because capital expenditures are going to be low, right? I mean, you saw their EBITDA is $250 million, but yet their CapEx is only in the low single digits per quarter. So about 10% of their EBITDA is going to CapEx. And that's just the nature of the business, right? I mean, you're not running a heavy asset manufacturing business. You're just running kind of a middleman dealership operation. The downside of those type of operations, by the way, is that it's more competitive than the manufacturing one. You can kind of build a moat with assets, but I'd rather own the asset light business, right? Okay, and then lastly, we're going to go to financing cash flow. Financing cash flow, I say lastly, we're going to look at free cash flow too, but financing cash flow is a cash flow section that you really want to see negative, right? Because what is financing cash flow? That's really going to be three things. It's going to be If they're paying dividends, it's going to be negative because it's going to be cash leaving the business. If they're buying back stocks, it's going to be negative because it's going to be cash leaving the business to buy stocks. And then if they are, what's the last one? Paying debt, it's going to be negative because it's cash leaving the business to pay down debt, right? So what's positive? The opposite of all that. So if they're going into more debt, it's going to be positive. If they're doing a secondary offering, it's going to be positive as well. The stock-based compensation is not going to be counted here because it's counted in the operating cash flow. But like if they were to do a secondary offering, it'd be counted as positive free cash flow, positive cash flow. And then there's no such thing as a reverse dividend, right? Or at least I hope to never see one. So that wouldn't be it. But it would be, in this case, it's the debt, right? They're going into more debt. And so that's why that's positive. So that's a little concerning as well. But lastly, we're going to look at free cash flow per share on a trailing 12-month basis. So this is going to be a full year number. And this is super concerning, okay? So on a full year basis, on trailing 12 months, you have a negative free cash flow per share. All right, and just this is why I hate EBITDA, and especially adjusted EBITDA, because look at this graph, okay? So this graph compared to their adjusted EBITDA graph. One of these things is not telling the story, the full story, right? My guess is it's this thing, this number with all these acronyms in it, right? But anyway, I mean, just looking back to free cash flow, if you really think that this is just a seasonal downturn and they're going to be back even to this low $5 a share free cash flow, I mean, the stock is still selling at a single-digit multiple of free cash flow if you think it's going to be in that $5 a share, okay? So still pretty good there. But this is what really intrigues me, okay? And I'm going to go back to the EBITDA thing. I know I'm jumping around, but I think it's important to go about it this way. Okay, so back here, if they were to grow at like let's say even half the rate that they've been doing, so instead of 69, they grew at 34%, okay? 34% for the next 5 years. Okay, so I raised that to 5, so that'd be 4 times in 5 years. And I multiply that by their EBITDA to get what the EBITDA would be in 5 years. It would be $1 billion of EBITDA in 5 years. If they can even convert half of that to free cash flow, or let's not even say half of it, let's say 33%. So if they convert 33% of that to free cash flow, you're talking about a company that is making $360 million of free cash flow. I mean, that's going to have a market cap of, let's put a 12 multiple on it, 4.2 billion. So you're talking about a 10x in like 5 years, if that happens, right? If they grow at half of it and they're able to convert some of that EBITDA to free cash flow. And I think that kind of answers my question for me, because there are some red flags. I think that it's a very cyclical and seasonal business, and it could get really hit hard by a recession, especially with the high debt, but it's got a very asymmetric upside potential, right? And so to me, this is going to be one that I'm holding. I'm not going to be swinging huge on this, but I think I'm happy to have a small bet. If it does great, that's awesome. And if it loses money, I'll just pretend I bought a boat and I lost my money that way instead, right? Because what's the difference? All right, but that's all I got. I hope you learned something. I hope you watch more of my videos and you like and subscribe. I'll see you next time.